This is Steve Wolf with another of Steve's Stock Story podcast, and I'm here with my cohort, Jocelyn Magana.
How's it going, everybody?
All right, well, it's nice to be with you again with another one of our podcasts. Did you ever worry about, or did you ever wonder about how you can make money when stocks go down?
I've heard you can. I've had people say it. I have wondered about that. Yes, I don't understand how it actually works.
Well, I'm going to talk to you about the ninth wonder of the world today, and it's called short selling. Okay, you may say, what the heck is short selling? So basically, what short selling is pretty simple concept. When the stock goes down, you can make money by doing this. And what you do is you actually go out and you borrow stock from someone who owns it.
Okay.
All right. You then go out in the open market at the same time and sell that stock.
Okay.
So now you got some money in your account. But the original the original lender of the stock says, hey, I want my stock back at some point. So you've got to eventually go out and buy the stock.
And they don't care what price they get that stock back at? It's just like they're letting you the stock to use, and it doesn't matter if it comes back at a lower price, higher price. They just want their stock back.
Well,
like loaning a car or something.
Well, yeah, theoretically that's correct. But let's say that you lent out the stock, and now someone else has control of that stock, and it goes up in price. Okay, but you eventually will get your stock back. Well, yeah, that's a good thing because you're going to get the stock back at a higher price. Now, you could get the stock back at a lower price.
Okay.
At which you're probably not going to be that happy unless you say, hey, I don't really care, because in the meantime, you might be getting paid interest payment on that. Okay. And if the stock pays dividends, you as the person who lent the stock, remember you still own that stock, theoretically, okay, you get the dividends.
The person that lent out the stock. The
Correct.
person that actually owned the stock that's lending it out to the people that are using it in the marketplace.
Correct. Now, how is all this accomplished? It's accomplished through what's called a margin account. Margin is basically where you can borrow money against securities that you already have in an account.
Yeah, so it's securitized or it's collateralized by your existing holdings.
Correct. So, if you've got an account out there that's, let's just say, worth $500,000, and it's got all sorts of stocks or bonds or whatever in the account, you can borrow a certain amount of money against that. Now, you can borrow actually more money against a bond than you can a stock, but you can still borrow against it.
Okay, this is going a little bit back to kind of what we talked about in leverage before. But before we go any further, because we're getting into some murky waters here and people might get the wrong idea. Quick disclaimer, since we are talking about, I'd say, advanced concepts, of which I am learning and Steve is teaching here. And we are not giving out advice. We're not suggesting you do this. This is just more from an educational purposes. The only way you should be getting advice is from your licensed advisor. If you're one of our clients, then you need to talk to Steve or Catherine or any of the other licensed advisors here at the office. If you're not working with us, you need to talk to a professional. This is not financial advice. This is educational.
Well, this is actually a pretty advanced strategy. And if you're not a professional, you don't really know what you're doing, you can get burned on this.
Yeah, this is for really professional traders. And just because you got a computer screen and you took a couple of trading classes that you got, on an ad online that's not going to qualify you.
Right. Because the risk on this, remember, so let's go through it again real quickly. What's happening is the way it actually works is you're going through a broker dealer. So let's say you've got your account at Schwab.
So broker dealer, just so I'm clear, because there's all these terms: broker dealer, fiduciary, RIA. What's a broker dealer?
Well, actually, it's whoever actually holds the stock.
Okay. So the person who owns the stock,
not the person, the institution,
the entity.
Right.
Okay.
So let's say that you're holding your stock through Charles Schwab.
Okay.
Okay, what actually happens is Charles Schwab would go out into the marketplace.
All right.
And find stock. So because you want to borrow that stock so you can sell it.
Okay, so we're circling back on how the mechanics of this short sale.
Right.
All right.
So they're going to go out and they're going to find the stock. Now, interestingly, if the stock is really liquid, in other words, if there's tons of volume, it's buying and selling like water, like many of the stocks, Apple, computer, probably Amazon. I mean, any of the ones that
The big blue chip type stocks.
exactly, the ones that trade a lot.
Okay.
There's no problem usually with borrowing it, and because of that, you don't even have to pay interest in many cases.
So let me get clear. Okay, I come to you. I say, "Hey, Steve, we've discussed this whole thing. It all makes sense for me, and you're going to help me short sale a stock, right?" And so, what we'd actually be doing is you'd be going to Schwab to borrow the stock. Is that how that would work?
We would be going to Schwab, and we would say we want to short XYZ stock.
Okay.
Okay. Then Schwab says, okay, this is an easy to borrow stock, so they'll go out in the marketplace and borrow it from somewhere.
Okay. So there's another institution that may have that stock. They're holding it. They own it.
Correct.
Okay.
Okay. So they say, okay, we're going to borrow the stock.
Okay. Schwab borrows the stock from this other
Now,
entity.
Right. And what happens is then we go out, you as the account holder go out, and you sell that stock right away. That's what shorting is.
So let me circle back. So Schwab borrows this stock from another institution for me.
Right.
And at what point do I get to
Immediately.
So now
it goes in your account.
Okay, so it goes in my account. I've basically essentially Schwab is a middleman who's helped me borrow this from somebody else.
Right. And you're immediately selling it.
And so as soon as I get it, I sell it at whatever the market price is
Correct.
at that moment in time.
Right.
So just for examples purposes, I'm going to use, say XYZ stock is the market price. I've borrowed it through Schwab and the strike price at that point is $100.
Right.
Okay. So
When you say the strike price, the price at which you're selling it.
Yeah, I may be using incorrect terminology here. So I've instantly borrowed it and sold it. So I don't even have it anymore. I borrowed something from somebody, and I sold it to somebody else.
Correct.
And I'm sitting there with proceeds from the sale, of which something I didn't even own. But I've got money in my account.
That's right.
Not my money, but
that's correct. Now, because it's a margin account.
Okay.
Okay. You may be paying margin loan, but what a Schwab will do is actually they have 3 different subcategories in a margin loan. Without getting too esoteric here, they have cash, margin, and short account. This would go into the short account part of your account with Schwab.
And so just so I get this clear, when I borrowed this, they just didn't let me borrow it scot-free like a unsecured credit card. This was on margin against my existing.
Well, yes and no.
Okay.
Okay. If you have a margin account and you're on margin, in
Yes.
other words, you've borrowed against it, you will be paying a margin loan.
Okay.
But if this is a not hard to get stock like an Apple or like the ones we talk about, whoever it might be, IBM, who knows?
Yeah.
Then there really isn't a payment that you have to make. There's no interest payment on that. So there's also 3 categories of this. One, let me finish. One is there's an easy to get to borrow. Then there's one that's hard to borrow. And then there's one that's in the gray area where they may or may not be able to get it. The one that's in the gray area, you're probably going to have to pay some margin loan, some on this short sale. And it's generally speaking, from what I'm being told, it's somewhere between right now about 1% and 5%.
And this would be for more of an obscure.
One that's in the middle.
Yeah, that's what I mean. Little bit.
But the one that's hard to get, for instance, in the not too distant past, all the cannabis stocks.
Okay.
They were not only were they hard to get to borrow, but there was huge demand to borrow them because people thought they were way overvalued, which in fact it turns out that they were. In that case, you could have been paying as much as 80 or 90% in interest for in margin interest for that particular one. So it depends on what it is that you are shorting.
Okay.
All right. Now you say, well, and that, by the way, that's an annualized rate. So you're saying, well, how does someone make money if you're paying 80 or 90%? And the only way you can make money on something like that is if the stock goes down quickly. Because when the stock goes down and you buy it back, you've made money. Think of it this way. Let's say you bought XYZ stock. You sold XYZ stock when you margined it at 50.
Yep.
And now you're buying it back at 20.
Yep.
Okay. Do the opposite. You bought it at 20 and you sold it at 50. Buy low, sell high, or sell high, buy low in this case. So that's how you make money. When the stock goes down, you're buying it back at a lower price than what you sold it at.
Yeah, and just so you're clear, as soon as you borrowed it from Schwab for the short sale, you sold it. You're sitting there with the proceeds of whatever that amount was. Say it was, like you said, $50, right? And then you go out in the marketplace and you buy it for 20, but you were sitting there with that 50, but you got to get that stock back to Schwab. I mean, they don't care what price that is. You give them back the stock. They're happy to get their stock back, and you've pocketed $30.
You're talking about the person doesn't care. You're talking about is the lender of the stock.
That's correct.
Yeah, they don't care about the price, but they want the stock back.
Yeah, well, they've got to get the stock back. It's like any property that you loan out. They want their property back. You get to use it.
Right.
But at some...
Now, here's an example of where they may not want it back. If you're paying 50% or 60% because it was one of these hard to get positions, then you may say, hey, you can borrow that for as long as you want. I'm getting 50 or 60% on that.
I see, because they're making money on to lend you that stock, and it's hard to get. Then they're just going to make money renting it out, basically.
That's exactly right.
That's a lot of money they're making renting that out.
You're right. I mean, let's say you own a car and it's worth $20,000, and somebody's going to pay you, $10,000 or $15,000 a year to borrow it.
Oh yeah,
keep that for a long time.
Yeah, I'd be renting that out all day long.
Right, and that's pretty much what this is. Okay, so again, the stock's being borrowed, you're selling it right away, and you're buying it back. Now, how do you lose money? What's the risk? Okay, the biggest risk is that the stock goes up in value when you're shorting the stock.
Okay.
Okay, so let's say you sold the stock.
Okay, I get it now. I see what you're saying. Go ahead and explain.
You sold the stock at $50.
Yep.
All right.
You borrowed it, sold it, and you're sitting there at $50.
Right.
You don't have anything but the $50 now.
And now you're expecting that stock to go down so you can buy it cheaper.
Yep.
Okay, well, what happens if company comes out with a great report or something, a quarterly report that's fantastic, and all of a sudden that $50 stock is now $75 or $100? Okay, and you're saying, well, wait a minute, I'm losing every time that stock goes up in value, and there's no limit theoretically as to how much you can lose, because a stock can again theoretically go up forever.
It's just like borrowing anything from anybody, right? So you've kind of borrowed this. You said, hey, I'm going to get this back to you, but you sold it, so you don't even have it anymore. You got the money for it at $50. It goes to $75. You're running out saying, hey, I'm trying to make a deal. I want to get this for lower so I can just give them back the stock and pocket the difference. Right. And all of a sudden now it's at $75, and you have to you got to get them back the stock, and the only way you're getting that is buying it at $75, so you take a $25 loss.
Right.
And there's no limit to that.
There's no limit. So
oh my God.
Theoretically, I mean, you could lose 10, 20 times your money. And I mean, let's say you shorted Tesla, which there were people shorting.
Yeah.
And you shorted it when it was at recently, maybe when it was at $100 or $200, and all of a sudden it's at $1,500, and you haven't bought it back. Well, you keep losing and losing and losing. Obviously, I mean, at some point you probably would be smart enough to buy it back. And by the way, there is, in very rare instances, there is a possibility that it's in the contract that says that the Schwab who is facilitating this, or Merrill Lynch, or whoever it might be, they can actually force you to buy the shares back. It doesn't. It rarely happens.
What scenario would they do that?
Well, maybe if it has to do with margin. Okay, so if your maintenance perhaps on your margin agreement goes below 25%, in other words, that the value of what you have is 25% of what you've borrowed, then they may say, hey, you got to come up with some money, or you got to buy back the stock.
They're worried that you may not be able to pull it off?
Correct. I mean, but again, it's rare that happens. And again, I was being told this by some Schwab people here recently.
So let me just get clear on this. So when someone chooses to borrow, say, hey, Schwab is basically vouching for you, right? Schwab says, okay, I'll make this arrangement with this another institution or entity to borrow this for you.
They're not really vouching for you.
Well, I'm just saying in regular terms, right? I'm just saying in regular guy terms. This is how this is how I see it. I'm not talking about technically what actually happens in my regular guy version of this. Okay. Because it's not Schwab stock. They're getting it from somebody else. Right. And they give it to Schwab, but Schwab's got to make sure that you can make them whole. Right. So you're not actually just getting this because Schwab says, hey, you're a good guy and we like you. They're saying you've got to have a margin account, which means you have to have some assets, right? And they're going to say, look, we're going to collateralize. That's the margin, right? We're going to collateralize your assets.
Exactly.
And what they're saying to these other folks, hey, we've got people that we work with, and that's when I say vouch for them, right? And don't worry because we've got them set up with a margin account.
I wouldn't even go to the vouching part.
It's how it works in my brain. I get that that's not what actually happens.
Right.
It's just how I see it happening. But you're not actually able to borrow this. You have to have some skin in the game with the margin account. You have to have
a margin account.
Right.
So that's how that works. Now, here's a real life example of what can happen that can go wrong. There was a person whose name, by the way, some of these advanced things, there's a bunch of secrets to making money in this market. If you're really interested in getting something that I put out not too long ago, it's my 5 secrets of investing. You can go to WWM Financial, Carlsbad, CARLSBAD.com/investing secrets. Let me say it again. WWM Financial, Carlsbad.com/investing secrets. And you can take a look at that. And also, if you want to hear any of our other podcasts, which I hope you might want to, just go to our website at wwmfinancial.com. And there's a
podcast tab there. So you just go to the website, up on the top, it'll say podcast, and then you'll see all of the different episodes that we have. And we cover leverage in one of our previous episodes. I think that's a really good one.
Okay, so here's an example of what can go wrong.
All right.
There was a fella, and I think he was from Sweden or somewhere near there. His last name was Kalamaji, I believe. And I saw this in a Wall Street Journal article. And he decided that, he'd been actually trading for himself for nearly a decade. And he was looking at some of the smaller, more volatile stocks for a potential opening to short a stock. Because a lot of times, sometimes when it's not as well known and you think you know a lot about that company, maybe you have an advantage. I don't know if you do or you don't, but that's what you might think. Well, he found one back in, I think it was back in July, and that's Eastman Kodak.
Okay.
Now, most people know Eastman Kodak as a film company.
Yeah, I think the old cameras, the old film, and then the machines they used to have in the Walgreens or
exactly.
Whatever.
So he decided to short the Kodak stock. Now, what happened with Kodak is that the U.S. government gave them a $765 million loan.
Million?
765 million is in million.
Okay. All right. Well, it stays better than billions.
But to make pharmaceutical ingredients, and it had to do with what's going on with all the COVID stuff.
Yeah. So we're gonna have a film company making pharmaceuticals.
Exactly.
Okay.
Exactly. Now, guess what happened to that stock when that happened? Oh my God! It went straight up. So here's what happened. So the stock tripled, and he hadn't shorted it yet. The stock tripled. All right. Now Mr. Kalamaji's thinking, okay, it's gone up a lot.
Yep.
This is going to come back down to earth, and this would be a great time to short it.
People are going to be thinking like I'm thinking, why is a film company making pharmaceuticals?
That's right. Well, he intended to short 45,000 shares, and this was during the day that it happened.
Right.
But he accidentally clicked the wrong button, and he shorted all of his 90,000 shares.
Oh my gosh.
Okay, a split-second mistake that he decided to stick with.
Okay.
Unfortunately,
so he's saying, I'm gonna write it out. I'm gonna you know what the hell, I'm gonna go for it.
Unfortunately, it proved a little bit costly to him because Kodak shares rose 7-fold to roughly $60 a share intraday. The New York Stock Exchange, of course, halted it several times a day during the day because of what's called circuit breakers. But hey, he was stuck on that ride. Well, he finally closed out his short position after deciding he just wasn't able to stomach any more losses. So the trade cost him a mere $1.5 million.
Oh, my God.
Okay. And he said, it was the dumbest thing I've ever done in my life. You never know when they'll stop. You just have to get out.
So if a guy can even talk to the press about that like that, I mean, he must have been a player. I mean, he must have had some money. Yeah, because there's no.
Well, he didn't talk to the press.
He's got to pay.
No, he didn't talk to the press.
Oh, okay.
I think you're talking about another one that happened. That was Nikola.
Well, no, I'm just talking the comments. This guy about the dumbest thing. Yes, I mean, I probably wouldn't even take calls if I could, because he's got to pay that back, right? I mean, he can't just say, "Hey, I'm sorry, I don't have the money."
Right. No, he's got to pay it back. So obviously, he is a player.
Yeah.
But there was another one here recently, Nikola.
I saw that. I saw that in the Wall Street Journal.
Exactly. And that was a little bit different in that there was a fellow who was actually shorting the stock who did some research on his own. And it's my understanding, and we won't go into the legality of all of it, but it's my understanding that he had talked to some people who used to work there. And those people said, hey, what Nikola was saying. And by the way, Nikola is a company that makes the
electric trucks,
battery operated trucks,
right.
Correct. Or they don't even make them yet. They're hoping to make them. Okay. So he was talking to some of these people who apparently had worked for the company, but no longer. This is what the article was saying. And one of them said that some of the stuff they were saying wasn't true. For instance, he gave one example, which I thought was a little bit funny, in that they showed the truck going downhill. Okay, you think, okay, well, it's being driven downhill. Well, no, it wasn't being driven. It was just being rolled downhill.
Oh my gosh,
So-
like a movie prop,
Exactly. Well, what's happened is that the CEO of Nikola has actually resigned, but he's still fighting it. And I'm sure there's going to be lawsuits, and you got to be really careful about this, because if you come out with something that's totally false, I would think that there would be redress with lawsuits.
Well, I was looking at that article as well, and the first thing they point out is this guy who wrote that article is practically bankrupt from defending himself from previous short-selling articles. Not even the Nikola article. Like, he's been writing all these articles just trying to win some shorts, right? And he's just getting the pantsuit off of them because you can sue somebody for anything, right? And so he's having to defend himself, and
So that's what can happen in a margin account. So you got to be really careful. This is something that you really need to know what you're doing. We don't recommend this for the average investor out there. Really don't. Even though you may be right, there are things that can go wrong that you may not be able to recover from.
Yeah, this is. I think it's great to know how this works, especially to know how it works and know how you can get banged up. Sure, you can make money doing this, but the problem is that the downside is unlimited, as you just mentioned, right? Like, you basically can get completely wiped out.
Oh yeah. Yeah, you can do that. And you don't want to be sitting there with margin calls coming at you, meaning that you have to either come up with more money or sell, or in this case buy back, I guess, what you had sold. Or if you're in a regular margin account where you're borrowing against securities that you own, you don't want to have to sell them at the wrong time. That's a real risk of any margin account. Which is why, for the most part, we try to steer people away from margin. There might be a time to use it, but it's something that should be done by talking to whoever your financial advisor is.
Yeah.
So that's kind of what short selling is all about.
I'm glad we covered that. I watched The Big Short on Netflix, and I watched another Netflix episode where this woman was. This is actually pretty fascinating on how much research. Insane amount of research these professional short sellers do to figure out if a company is really not what they say they are, and to profit from that research. I was completely fascinated, but I didn't fully get that the whole mechanics of the Schwab and the institution, and you actually are borrowing this and selling it, and basically you're sitting there with money and you've made this deal and it's very interesting the way these mechanics work.
There are other ways that you can profit from stocks going down. One way is by using options. I don't want to get into option strategies or anything like that, but it's a different way of doing it, which may have actually less risk to you. We'll do that at another.
Yeah, that sounds like
podcast.
a whole nother murky.
It's not murky.
No, I just mean like a whole. For me, it's all murky because this is all new. This is a whole nother topic. You could go jump and
we're gonna start calling you Mr. Merck or something,
Yeah,
and I don't mean Merck Pharmaceuticals.
I'm clear on short sales now, so my windshield's here have been wiped off, but I'm learning a ton doing this. I hope everybody else is.
All right. Well, I'm hoping that you guys learned from this. If you want to hear our podcasts, go to wwmfinancial.com. If you want the 5 Secrets of Investing, wwmfinancialcarlsbad.com/investing secrets. And this has been a pleasure, Jocelyn, to be with you again, and we'll see you the next time.
It's been great. We'll see you next time.